Good afternoon. My name is Kent Kramer. I'm the Chief Investment Officer at Foster Group. And with me this afternoon is Zach Dalluge. Zach is an associate advisor here at Foster Group as well. Foster Group is an independent investment advisory firm based in West Des Moines, Iowa. We also have an office in Omaha, Nebraska. Foster Group has the privilege of serving over 1,400 clients all over the United States. And those clients range from individuals and families to institutions and nonprofit organizations. We're glad to serve them all. Both Zach and I have a political past, it turns out, policy things, and I'm just going to ask him questions about some things so we can all learn together about something called the CARES Act. The CARES Act has been in the news a lot recently. It's the very large $2 trillion plus economic aid package passed by Congress and signed by President Trump, and it had a variety of things in it for individuals and businesses, states, hospitals, all kinds of things designed to keep the economy running or ready to run again once we're past this coronavirus problem that we've had around the country. So, Zach, one of the main features of the CARES Act is something called the Recovery Rebate, which I know consists of direct payments to taxpayers, especially to help with those who've been impacted by the coronavirus, either through loss of employment or other kinds of economic hardship. Can you tell us a little bit about who's going to be eligible, what those rebates look like, how that's being outlined in the bill?
Yeah, Kent. So the eligibility for the rebate depends on income. There's a couple different aspects to that. As far as the actual payment amount, the base payment amount is $1,200 per taxpayer. So if you're single, that's $1,200. If married filing jointly, that's $2,400. But in addition to that, there's a $500 addition for each dependent child under the age of 17. What else factors into that is the phase-out range. We've listed here on this chart the phase-out ranges for single, for married filing jointly, and then for head of household. And the head of household tends to be for single parents or single parent with dependent children. So the phase-out range for single starts at $75,000. So you would get that full $1,200 up to that $75,000 mark. And then as you make your way through that phase-out range, so from $75,000 up to that $99,000, the benefit would be stepped down up until you hit $99,000, which is when it would be entirely phased out. So similarly for married filing jointly and for head of household, those dollar amounts are just a little bit different. So for married filing jointly, that's $150,000 to $198,000. For head of household, that's $112,500 to $136,500.
So in terms of that income phase-out range, is that going to be based on previous year's taxable income, or is that going to be based on taxable income, let's say, for 2020?
Yeah, so that's actually based on 2020 income. The way the IRS is figuring out who is eligible for which amount is based on your 2018 or 19 return, but it will ultimately be based on your 2020 income. So since we don't know what that 2020 income is yet, the IRS is going to use the 2018 and 2019 to figure that out. Essentially, if you were eligible in 2018, or if you have filed your 2019 tax return and you were eligible, you'll receive that payment. Let's say, for instance, that you filed your taxes in 2018 as married filing jointly and you made $200,000, so you're above that phase-out range. You retired in 2019 and haven't filed your taxes yet. In 2020, you technically would be eligible. However, because of your most recent tax return, you wouldn't be eligible. So the way that they'll work that out is based on when you file your 2020 income tax return, you'll be able to get that stimulus amount as a refundable tax credit to your return at the time of filing.
So I noticed the last bullet there on the slide says the recovery rebates are not going to be taxable. So the money that people receive, they won't need to claim that on their tax return?
That's correct. So since it's a refundable tax credit, it will not be considered taxable income.
So in terms of the mechanism for people to get the rebate, how is that going to happen? How will the IRS or the federal government kind of identify who should get it and then transmit the money so people actually get it in a timely fashion?
Yeah. So if you filed a 2018 or 2019 tax return and had the direct deposit information on there, the IRS will use that direct deposit information to deposit the check. If you did not file a 2018 or 2019 tax return and say you're a Social Security recipient and you don't make enough income to actually file that return, then you'll receive your payment where you receive your Social Security check. Another addition to that is if you did submit your 2018 or 2019 return and you didn't include direct deposit information, so you just received a paper check in the mail, the IRS will actually be sending this as a paper check as well to the last address on record. Last we heard, the IRS is actually working on setting up a website so that if they don't have your direct deposit information, you can go online and submit that so that you'll be able to receive it sooner. Otherwise, the paper checks won't be going out until, at this point, they've said several weeks after the direct deposit payments are completed.
Well, that'll be interesting to see. I'm sure people are going to have a lot of questions, going to be looking for money in the mail or in their bank accounts. So you mentioned that the IRS is the one kind of coordinating this. Will there be a location where people can go to find out whether they're eligible or whether their payments have been made or what they should be expecting?
As far as timing and as far as knowing whether or not you're for sure receiving the recovery rebate, timing, the IRS has said that they're going to be doing that as soon as possible. In fact, as we're speaking right now, I've already heard of some people that have already seen that first round come into their checking account if they had their direct deposit information on file. So it's very likely that that'll be coming soon if you haven't seen it already. Another thing the IRS is doing, especially since it's so widespread and it's something that is going to impact most taxpayers, is they're going to be sending a letter to every taxpayer that receives the rebate within 15 days the payment is made. This is kind of a security mechanism just to make sure that you can verify that you actually received the dollars and that it was deposited into the right account. So if you did receive one or receive the rebate, you should be receiving that letter from the IRS.
Well, I know this was put together and passed in a hurry, and there's a lot of rules and regulations still being formulated with different parts of the program. So taxpayers, individuals are going to, I'm sure, see more and more information come out about how they can check and where they should go if they have a question about the program. It seems like at the end of the last year, we were just together thinking about something called the Secure Act, which had a lot of changes to retirement plans and people's retirement investing. And of course, the CARES Act has some impact on that as well. It impacts people's required minimum distributions, how they're taking IRA distributions this year, particularly because of what's happened in markets due to the coronavirus. There's been some relief for people who may not want to take those distributions or do something differently this year. Talk to us a little bit about those changes.
Like you said, with the Secure Act, Congress had just made some changes to that required minimum distribution and pushed that out from age 70 and a half to 72. And now with the coronavirus, they've actually suspended all RMDs for 2020. Regardless of whether you're taking your first RMD at age 72, if you're under that, if you're taking your required distribution as a beneficiary or as an inherited IRA, all of those are put on hold for 2020 so that taxpayers don't need to take dollars out of those accounts while the market is down.
So is this retroactive in any way? In other words, if somebody had already taken money out in January or February before the bill was passed and signed, is there any recourse for them to go back and maybe undo those distributions that were made early in the year?
There's nothing formally in the bill to be able to roll those dollars back in. For individuals that have taken a distribution thinking that they need to take their RMD and they don't actually need those dollars, one of the planning tools that we could look at using is a 60-day rollover. So as long as those dollars were taken within 60 days, we can actually roll those dollars back into the IRA so there won't be that taxable impact. As far as individuals that have taken an RMD from an inherited account, so from a beneficiary IRA, there isn't a way of doing that because there isn't the 60-day rollover option into those types of accounts. So unfortunately for those individuals, there isn't a way to get those dollars back in.
Okay. Well, it's kind of important to remember that the bill was passed in March early and people took distributions in January or February, at least from a market standpoint. Markets were generally higher through the middle of February, so they might not have been hurt as badly by someone who had to take a distribution maybe in March after markets had fallen quite a bit and would rather have not sold in that market, but would rather have held if they could. So this is a nice thing for people to be able to look at and consider whether they need the money or not, or whether they'd like to put it back into their investment account. Along with IRA distributions, I know there are some changes in charitable giving as well. So again, I'll just kind of turn it back to you, Zach, to tell us kind of what things were touched in terms of charitable giving in the bill.
One of the first items I want to touch on is the qualified charitable distribution. We had mentioned in the last webinar, in the Secure Act webinar, that QCDs, or the qualified charitable distributions, remained for individuals that were 70 and a half, even though the RMD age changed to 72. So similarly with this year, with the RMDs being suspended for 2020, individuals are still able to use that QCD option up to $100,000. So if someone still wanted to use their IRA for gifting, they'd still be able to do that in 2020, even though no RMD is required. So in addition to that, traditionally there is a 60% AGI, or adjusted gross income limit, for cash contributions to charities. So you could only deduct 60% of your total adjusted gross income through a charitable gift. So for 2020, they've actually bumped that up to 100%. So if individuals want to be more charitable, the intent behind that would be getting dollars to organizations that are helping people out through these times. The IRS has allowed up to 100%, which is a pretty big move.
So the idea there is, let's say someone's AGI is $100,000 adjusted gross income. In the past, they only would have been able to deduct $60,000 if they'd made it. Let's say they'd gifted the entire $100,000. Only $60,000 would have been eligible for a deduction. But because of this act, if they have $100,000 of AGI and they want to donate all of it, they don't need the income because of other income resources or wealth that they might have, the entire $100,000 would be deductible in 2020.
Correct. That's spot on.
And I see there's one more thing there about a above the line charitable deduction as well.
Yep. So, and this was actually a permanent change that got added into the law. Another change they did was adding the $300 above the line charitable deduction, but only if you're taking the standard deduction. Back in 2017, when they passed the tax reform, there was some concern that when they doubled the standard deduction amount, that individuals weren't going to be able to deduct as much of their charitable giving. So this was a way to get a little bit of relief, even though it's fairly small in the scope of things, to allow taxpayers that are giving charitably to deduct some of that from their income.
It kind of works as an encouragement for people who are taking the standard deduction and they know they're not going to be able to itemize any kind of a charitable deduction. This at least gives them some incentive and small credit for doing something charitably if they'd like to, which at times like this, I'm sure every charity who's doing really quality work is looking for as much help as they can get. Let's talk a little bit about some other provisions. I know, this bill tried to anticipate all the different ways that people could be negatively impacted by what's happening within the economy due to the coronavirus and the spread of things and how the economy is slowed down. What are some of those other additional provisions? I know some of them have to do with the use of IRAs and retirement plans. Other things have to do with unemployment benefits, things like that. So kind of walk us through those.
Some of the other provisions in the bill, the first one I'll start off with is on retirement plans. The law is allowing for coronavirus-related distributions penalty-free up to $100,000. The penalty that we normally talk about in that circumstance is the 10% penalty if you're below the age of 59 and a half. And it also allows for the income tax on that to be spread over 3 years. So even though you're getting that $100,000 out of your 401k penalty free, so you're not paying that 10%, if those are pre-tax dollars, you still will need to pay the actual income tax on that. The relief in that is allowing that taxable impact to be spread over 3 years. But in addition to that, it also allows taxpayers to roll dollars back in over that 3-year period. So it's kind of a way of accessing on an emergency basis some of those funds that are in that retirement account. The other item on that as well is that it's not subject to mandatory withholding. Normally, those types of distributions would be subject to mandatory withholding from your employer, so you wouldn't get that full $100,000. In addition to the distributions, there's also some changes on employer plan loans. Prior to this law passing, you were limited to taking either 50% of the vested balance of your 401k, 403b plan up to $50,000. So 50% of the vested balance is the max, but only up to the $50,000 threshold. That's been doubled. So now participants are able to take full 100% of the vested balance, and that limit's been doubled to $100,000. And there's also relief in the sense that the payments on those 401k or 403b loans could be delayed throughout 2020. So they wouldn't have to make those payments then.
So those two items there, just looking at the loan versus the distribution idea there is when you take that out, it's basically going to be taxable income to you. You are going to avoid the 10% penalty on a pre-59.5 withdrawal, which is great, but it's still going to be subject at some point to taxation, even though you're going to get all of it because you're not going to be subject to mandatory withholding. But on the plan loan, when that loan comes out, the way I understand it, that's not a taxable distribution. So that's coming to you with the idea that you'll pay it back over some period of time.
That's correct. Not all plans do allow for loans, but as long as the 401k or the 403b plan does allow for plan loans, the restrictions on that have been loosened. Traditionally, what happens then is over roughly a 5-year period, the payments are actually set up directly out of your payroll to reimburse that amount with interest.
So this one is probably one where if someone were really considering some kind of a pre-59.5 withdrawal because they needed money from their plan, it would really make sense to talk to their advisor, to their accountant, something like that to make sure they're doing it in the most advantageous way.
Absolutely.
So let's go on. I know there's some more provisions that we've got lined up here talking about unemployment benefits. What else is going on in this as a result of the CARES Act?
Unemployment benefits was a big one. And just talking through some of the history on this bill, it actually took several days to get through Congress. There was quite a bit of back and forth with primarily Secretary Mnuchin and Senator Chuck Schumer from New York. So because there were two parties that were negotiating on this bill, a big priority of the Senate Democrats was the unemployment benefits and the specifics on that. What that offers is an extra $600 per week of jobless benefit through July 2020 on top of what the state program pays out. While it's tied to it, it's separate and above what the state benefit is. And then secondly, and this is a key one here, is it expands access to workers that are not traditionally covered. So traditionally, independent contractors or freelancers would not be eligible for unemployment benefits because they haven't paid into the unemployment tax or the unemployment insurance system run by the state. But with this bill, it allows them to take part in that $600 per week jobless benefit.
So what are some examples of people who would fall into that independent contractor or freelancer category?
Primarily, that's going to be anyone that earns 1099 income. Think of people that are doing, maybe for instance, like graphic design. If you're running your own type of business and you're being paid on a contract basis or through 1099 type of work, then you'd be eligible for that $600 benefit if you were out of work.
Okay. So I've heard basically like non-salaried workers, non-full-time employment people actually have an opportunity here because of their jobs being or their sources of income being impacted to get an unemployment benefit where before they wouldn't have been eligible.
Correct.
As any bill comes out, as you and I both know, there's the details are extreme in terms of things get a little confusing at times. One that's gotten a lot of attention and seems a little confusing is filing dates in terms of when payments are due, when tax filings need to be made, and how that coordinates between a federal tax filing and a state filing date. So give us a little help here. What do we know so far?
For anyone that's filing their ordinary income tax for 2019, that's actually been delayed until July 15th of 2020. Where it gets a lot more complicated is when it comes to the estimated tax deadlines in 2020. As of right now, the quarter 1 and quarter 2 payment is actually due July 15th. Quarter 3 and quarter 4 so haven't been moved at all.
Anything else that we should know about additional provisions for individuals?
A couple more I'd like to point out are on the medical and on the student loans. For medical, a big one is with HSA, FSA, and MSA accounts. You can now purchase over-the-counter medications using those accounts. So previously, you would have to get a prescription from a doctor in order to purchase over-the-counter medications with HSA, FSA dollars, but now you're able to do that without the prescription. Medicare Part D recipients are able to receive 90-day supply of medication. And then on high deductible health plans that are the ones that are generally tied to a HSA or the health savings account, telehealth services are temporarily being covered by those plans directly rather than having to use the HSA dollars for those. And on the student loan side, interest and principal payment, so payments altogether have been suspended until July 30th. Voluntary payments can still be made, but those will apply 100% towards the principal.
That's nice. So it gives you some flexibility there. And if your income is still in good shape through this time, you can use that to kind of get ahead with the student loan payment. If your income has really been affected, there's an opportunity to suspend a little bit of that payment just to take the pressure off.
Absolutely. Lastly, on the student loans, it also allows employers to contribute to the payoff of student loans up to $52.50 per year. Previously, that would have been included as part of the employee's income, and now that's being excluded from income. So it's an incentive for employers to help employees to get their loans paid off.
Okay, we're going to move on to provisions for business here. This one is getting a lot of attention in the media right now because it's been so popular, as small businesses have been applying to their banks, trying to get some loans to help them cover payroll expenses so they can keep employees on their payroll rather than furloughing or having to fire people and having them go to unemployment lines. I saw some things this weekend where the Senate and the House are both talking about funding mechanisms to add more money to this program because there's already been more demand for the dollars than there were initially put into the bill. Tell us how it works. I think it's called the Payroll Protection Program. And again, it's been very popular. A lot of news stories being generated around it. How does it work?
The Paycheck Protection Program is a program that's going to be run by the Small Business Agency, the SBA. And it's essentially providing loans to businesses to retain and to continue to pay employees throughout the coronavirus crisis. While they are loans up front, they do have forgivable provisions to them, which is the key item with this, is that as long as employers maintain their employment, as long as there's no changes, nobody's laid off, everyone continues to make the same that they did pre-coronavirus, that loan is eligible to be forgiven. These obviously have been extremely popular with businesses, and there's already been requests in Congress to increase that dollar amount and get more funding into the program because of that popularity.
So my understanding there is it's the kind of program where if your business is so negatively impacted by the coronavirus or by the economic downturn that you would not have been able to keep payroll without the loan, that the loan actually could be some or all forgiven. But if your business remains successful, in other words, your revenue continues, at the end of the period, that loan, that grant for the payroll protection program, would turn into probably a low interest loan, at which point the business would need to pay that back with a fairly small interest rate attached to it. Is that basically correct?
Correct.
And then there's some other ones there you've listed. Just kind of walk us through those. There's no lack of things in the bill. I mean, $2 trillion plus of spending. There's a lot of things that can be done, but these are the high points. Why don't you tell us about the economic injury disaster loan and then the retention tax credit?
The next one we want to highlight is the payroll tax delay. The payroll tax is what employers pay to Social Security and Medicare. So that's their portion of that tax that gets paid directly to the federal government. So they're actually allowing postponement of that payment throughout 2020. So employers can, again, use that as some dollars to bridge this time period where their income may be a little bit tight and they need to retain those dollars to pay other expenses or to pay employees directly. Just a little bit of relief from that sense. The next is the Economic Injury Disaster Loan Program. And this program has actually been in place since before the CARES Act. The CARES Act essentially just adds more dollars to it, but it's also expanded some access and allowed more employers to take part in that. These are loans. They're not forgivable. However, the CARES Act did add a portion to it of the Emergency Economic Injury Grant, which allows up to $10,000 advance on the program. And that $10,000 does not need to be paid back. So when employers are applying for those loans, there's an option there to request that advance. And if that's approved, then that $10,000 or up to $10,000 is taken free of any requirement to pay that back. Finally, there's the Employee Retention Tax Credit. That's a tax credit that's eligible for companies that either partially or fully suspend operations during the coronavirus crisis to help keep them afloat once this crisis passes.
So as we mentioned, a lot of new stuff in the CARES Act. There's going to be some things discovered along the way that work really well and may need more funds. There's going to be some other things that may not work as well. And it sounds like one of the aspects of the bill is they do have the ability to take funds from one program that may not be as successful or may not be as popular and move it to other parts of the program that are really popular and successful. But what else is kind of the go forward here on what we see on how they're going to continue to develop and deploy the aspects of this bill that are most helpful for people in business.
So when the bill originally passed, it immediately authorized $2 trillion worth of spending. And while this is a little bit small here, you can kind of see on this chart on the right-hand side that shows a division of some of the areas that that's going to go to. A lot of the uncertainty and not knowing for sure where dollars are going to be needed or what programs are going to be needed. It does allow a lot of flexibility. While $2 trillion is the immediate authorization, there's been projections that could eventually go up to $6 trillion worth of spending. So there's just a lot of additional requests being made through Congress, and also a lot of flexibility over which ones of these buckets essentially will need to be refilled up as time goes on. Again, continues to be a lot of uncertainty. We don't know how long this shutdown is going to last, how long those guidelines are going to stay in place. So while we've got some pieces here that allow for some flexibility and allow for some further funding, it's still possible that Congress may even do something more and pass another bill in the future, and just depending on how long this thing lasts.
I think you're right. I think there's a lot of uncertainty out there still regarding what the health circumstance is going to be, how soon we're going to find things to effectively treat people with the coronavirus, how soon we're going to identify vaccination options, how soon we can reopen the economy, and how quickly people kind of can re-engage in the economy, both going back to work or starting to spend and consume again. All those kinds of things are going to have a lot to say with how fast we come back from this event, both in the United States and globally. So, Zach, probably we'll be back talking about more aspects of this in the future, but thanks for your insight today. This has been super helpful. If people have any questions and they want to contact Foster Group, you'll see on the screen contact information for us. We would welcome any questions that you have. If you're interested in kind of reviewing your financial plan or wondering if this has some relevance to the way that you're investing, of course, we'd love to have those conversations at your convenience. So thanks again for joining us today, and we look forward to being back with you soon.